So my name is Jesús. I'm a principal on the investing team, focused on everything pre-investment, so pipeline through diligence, and then post-investment, primarily support our founders whenever they're raising a subsequent round of financing. And on the Slauson Co side, at a high level, we're an early stage venture capital firm rooted in economic inclusion. We lead pre-seed and seed rounds. We deployed capital from our first fund of 75 million, made 38 investments. We're now deploying capital from our second fund of 100 million. We have our amazing accelerator that's led by Mickey, as she mentioned. We're investing across the US. We're headquartered in Los Angeles, which is tied to our name, Slauson Avenue, for those that know the reference. But if not, it's a very culturally relevant thoroughfare that cuts across different communities, and is where our general partners are from. And the ANCO refers to everyone in our ecosystem that we aim to activate to support our founders in making sure that their vision is realized to its fullest potential. So again, today's topic is around a successful fundraising strategy. We'll cover a couple of different topics in terms of how to think about when, how much, and how to maximize your chances for a successful fundraise. And to kick things off, I'll talk a little bit about the timing of it, because timing, in the similar analogy to location, timing is very relevant for a successful fundraise. So these are a couple of notes. I'm going to breeze through them, but really happy to hear what questions, what things that you want to push back on. Those are always welcome as well. And then again, if you have any personal experience with having raised some capital, feel free to share that perspective as well. So whenever we advise our portfolio companies to think about fundraising, we want them to think about it as an inflection point. An inflection point can mean various things, and it's really up to you to define that. But it's really having a strong story about why you're fundraising at this moment versus raising at any other moment. And what you don't want to be raising is just because you need more capital. I mean, startups need capital to survive. That is sort of a given. But because investors have hundreds and thousands of companies to choose from, they want to invest in companies that are just taking off or about to take off, and you want to show how that inflection point is has the ingredients of that taking off, if you will. Some examples of what inflection points could be depending on your business and the stage. Let's say you just launched a product. You've been working on it for the past 8 months, and you just launched it. You're having great initial success, strong user growth, strong revenue growth, etc. That could be an inflection point. Maybe on the team side, you've been working on closing a key technical hire. You've been closing a key marketing hire that's an industry leader that has over 20 years of experience is going to really drive the go-to-market playbook. That could be another one. They've been working with you as an advisor for 6 months, maybe. So you have a little bit of a working relationship, and now they're ready to join you full time. That could be another example of an inflection point. Turning on monetization. So let's say you have a consumer product that sort of has a freemium model, and you just decided to turn on monetization, and that's going well. And then entering a new market. So let's say you're more geography based, you're in Los Angeles, and now you're expanding to Atlanta and New York. You've been able to write the playbook that you will use across different cities. So these are different flavors of inflection points. Well, what really you want is to frame the fundraise to say, hey, look, we've just done this over the past X months. It's going really well. And now we're fundraising to do more of that, to take us to a point in the future that's going to be exciting enough to raise another round of capital. Because if you're talking to early stage investors, we know that you're going to have to raise another round of capital. It's very seldom that, or very rare that you're going to just raise one round and you're going to not have to raise any more capital in the future. So investors want to know that by investing in this round, you have an idea of what it's going to take to get to the next round, but we'll cover that in another slide a little bit more. always recommending focusing on fundamentals over hype. It's easy to read TechCrunch, sorry, or talk to folks in different founder circles and compare yourselves and say, oh, well, this person raised this amount and I have more than they do. So like I need to be raising more money than they did or something like that. Or because you might be in a sector that's more in favor right now than not, you think you're going to be more successful than you should be. Really, at the end of the day, you need to focus on building an amazing product that people want, that people are willing to pay for, and figure out how to get that to as many people in an efficient way, over trying to drum up again hype and interest that's not tied to your actual business. And then whenever you do run a process, you want to make sure that it is efficient and effective. So we have other Slauson Spaces that cover some of these topics actually in depth. And we can link our Slauson Spaces YouTube in the chat as well. But having a list of investors that you want to target that's prioritized will go a long way for you. There are thousands of investors out there, venture capital firms specifically. The actual number is somewhere between 3,000 to 4,000. I say between because in 2021, there was a lot of funds that were raised. And unfortunately, a lot of those funds are not going to be able to raise another round of a new fund. And so TBD, once the dust is fully settled, how many are still around, but there's still plenty to choose from. And so you want to figure out who is the best partner for me in terms of stage, in terms of industry, in terms of sector, geography, etc. So really doing the work up front will go a long way. And then having your materials ready. So we'll cover a little bit this, we'll cover this topic a little bit more in depth in a couple of slides as well, but having your materials ready to go shows that you are prepared for that fundraise, as opposed to trying to put things together as you're doing the fundraise. That's just going to prolong your fundraise and in essence reduce your chances of successfully fundraising, because you want to make sure that you're putting your best foot forward. And one small way to do that is following up with materials quickly, efficiently, answering questions, so that you're not giving the investor any reason to take a longer time than they otherwise would have taken. Last 2 points: understanding what the macro environment is, depending on what newsletters you subscribe to, or who your LinkedIn feed is, or what you have on your Twitter X feed. You might have a perception of where the market is, but for those of you that have been around for a few years, 2021, it was a lower interest rate environment. A lot of capital was being raised and deployed at very favorable terms to founders, versus 2023, when we saw those numbers take a strong dip. And while we're not seeing as strong of a dip anymore, I don't think anyone is expecting the numbers to go back to 2021 level. And so in my personal opinion, things are plateauing, meaning that they're stabilizing, but it's not an amazing environment to fundraise in, because you have a lot of completely new companies trying to raise capital. You have a lot of companies from that 2021-22 timeframe that are trying to raise either new rounds or bridges or extensions or recaps. And if anyone has any questions about those, happy to share more. But there's a plethora of companies that are fundraising right now, which makes it a buyer's market in terms of investors having the ability to choose from a lot of companies that are trying to fundraise. And so that is different than 2021, where there was a number of companies being started. And so actually investors had to be more aggressive in the sense of giving better terms to founders. So you want to understand where we are in the cycle, and it helps to have investor friends that you can ask a little bit more of a candid conversation. There is data. Carta puts out a lot of reports, so does Crunchbase and PitchBook and many other publications. So you can subscribe to those. The negative thing there is that they're usually 1 to 2 quarters behind in terms of reporting actual data. So it's good to have investor friends that you're not just trying to pitch to, that you're able to ask candid questions to and get their insights. And then the last piece, which is an important one, fundraise because you want to do something with the capital. This sounds kind of silly, But sometimes, again, people think, oh, I can raise 1, 2, 5 million because I know that I have a strong background or whatever. But if you don't have an idea and a plan that you're going to put that capital to work, again, in service of accomplishing certain goals, it's going to put you at a disservice. You're not going to manage runway effectively and be a good steward of resources. And so thinking through the exact amount will help you in actually knowing what to do with it. I'm going to pause here to see how this lands. If there's any questions, pushback, concerns. And if there isn't, we can jump into our next slide. We have about five slides. So the next slide is about the amount to consider whenever you are going out to fundraise. I focus on pre-seed, but we can talk about seed as well. And the amount matters. Is it 250K? Is it 2.5 million? Is it somewhere in between? Is it 5 million if you're raising a seed round? Different amounts will have different expectations in terms of how much investors will ask, how many what type of questions they will ask, how much data they will expect. But from our perspective, if you're trying to raise specifically a pre-seed round, you're trying to prove something out. You have a hypothesis that you are trying to gain capital and expertise from those investors to support you in testing, is this right? Is this wrong? Some of those things that you're trying to prove is, can I actually build a product? If you are somebody who is pre-product, you're trying to get capital to build the company, the actual product to eventually launch and determine if there is market demand for it. Can you hire world-class talent? Just having access to capital is not going to solve all problems. It does certainly help. We will not downplay that, but hiring is hard, especially in this environment where there is a lot of good talent out there, and they have options, and you really have to sell somebody on the vision, the mission, in order for them to leave their maybe very cushiony big tech job to join you on this very risky but hopefully fruitful long-term journey. You want to prove that you can do that. And again, capital will certainly help, but it's not going to solve all of the problems there on the hiring front. Will people actually want to pay for your product? Maybe you are post-product, but you're pre-revenue. You've been doing beta testing with pilot groups, et cetera, but you haven't been charging, and so you want to start charging and understand how that lands, and ultimately grow your user base. And retention, once you have a product that's being used or people are paying for, will they continue to use it after they've first installed it or first signed up? Again, you're trying to prove something. And these are a couple of ways to think about what you're trying to prove. On this next point, there isn't an exact right amount. No one's going to say, oh, you're raising too little or too much. I mean, investors can certainly have an opinion, and it can be a conversation, but you want to come in with a perspective whenever you are fundraising about how much to invest and what you need, what you think you need in order to accomplish your goals. So the easy way to think about it is, well, I have this team, or I plan to hire these many more resources. And so from a cost perspective, burn will be, let's say, 50K per month. And I don't plan on hiring that many more after that. And so you just take 50 times however many months, plus however much you plan on spending on marketing or whatnot. And that should give you a ballpark number of how much you want to raise. And the second point is a quote that I actually heard from a founder many years ago, but I think it's still quite true. This round is always about the next round. And I alluded to this earlier, but as investors, you were trying to convince us that you know what you're doing, in the sense that you will have to raise another round of capital. Part of our job and mission is to get you to your next stage of the company's journey. So whenever we make an offer to invest in a company, we are enlisting ourselves in that shared journey of getting the company to the next stage, which, for better or for worse, means getting to another round of capital financing in the next 1 to 3 years. And so if you are able to talk about, hey, I'm raising this amount, and with it, I'm going to be able to accomplish X, Y, and Z, and this is how I plan to accomplish that, that's a conversation, as opposed to not understanding what those X, Y, and Z are, or what you plan to do with the capital, just fundraising and just saying, I just need $2 million, just like, let me have it. Which I know nobody in this room will approach fundraising like that. But you want to think about, okay, if an investor is thinking about, will this company be successful in raising the next round of capital, that matters. And there are some soft signals that founders can put in their deck or share in their pitch in a conversation that can make us have small indication of, okay, this founder really understands the market, understands the fundraising environment. And one way to do that is around this last bullet, that there are some nuances between a B2C and a B2B product or company. But generally speaking, for a seed company, the ideal metric to be at from a pure revenue standpoint is around $1 million in annual recurring revenue. Or said differently, if let's say let's say you're raising right now in June, as of May, you were able to generate $80,000 in monthly recurring revenue. That, from a purely revenue standpoint, would put you in a pretty strong place to raise a seed round. And why is that number important? Because for Series A, at least right now in this market, we are seeing companies that are successfully able to fundraise a Series A generating somewhere between $3 to $5 million in annual recurring revenue. And so if a pre-seed company has $80K in MRR or $1 million in ARR, and they are able to raise that seed round, then that investor knows they're trying to grow revenues 2 to 3 times year over year. So if you are able to hit with that seed round, let's say you have 2 years of runway, and then you 2x revenue, that will put you at that $3 million. If you 2x 1 million get to 2, and then you 2x that to get to 4, that will put you in a strong Series A territory. So that's a quick example of, that for a seed, you need to hit 80K in MRR. So if you're raising a pre-seed round, you need to have the metrics defined that will get you to that 80K. For B2C, it's different. Right now in this environment, at least from the deals that we're seeing, it's much more difficult to raise pre-revenue consumer companies. It's harder to raise for consumer companies if you're pre-revenue versus 2021, where if you were pre-revenue, but still had decently strong traction metrics, downloads, usage, etc., investors were more willing to look over that than now. People are much more critical about, hey, do people want to pay for this? Are people paying for this? How much are they paying? How long? And some of the fundamental retention metrics. So you want to understand, again, what are the important points to consider for your stage and your specific business model. I'm going to pause here to see if there's any questions. Might be some in the chat. Eileen, can you help me? Can you speak to the traction points that investors look for in different types of businesses? This vary by size. So I just touched on this a little bit, but maybe one other nuance to add there is, again, I mentioned that in this environment, a lot of companies are raising extension bridges or recaps or down rounds. Part of the consideration that investors take whenever they're making a decision or whenever a company is pitching them is, hey, this company might be really interesting, but they've raised $4 million already, and they have metrics that are just as good, if not worse, than this other company that has raised $1 million. So, and this company that's been around, that's raised 4 million, has been around for 4 years, as opposed to this other one that's been around for just a year. So capital efficiency has an important role to play as well, to take into consideration. So just because you can do a lot with a lot doesn't mean that investors will look at that favorably. At the end of the day, you're trying, from a venture perspective, you're trying to do a lot with a little. And that's not something that's easily done by just anybody. And so one of the points, more of a soft signal, is how much capital has this company raised and what have they been able to do with it so far. I think there's another question around capital raise journey. What are some of the milestones investors seek? So yeah, hopefully I touched on that through this conversation. Any other questions from folks that want to ask a question live? No? Okay, well, a few more slides here. This is not a slide that we created, and it's in euros. So take that with convert the euros to dollars. But I do like the way that this shows the different points of a company's trajectory and how that is directly or indirectly tied to the amount of capital that they will be fundraising. So I think this is a good way to put things into perspective and to call out some of the biases that exist in venture, for better or for worse. And for you as a founder to think about, okay, am I likely going to be able to raise 5 million, or should I be considering more, 2 million or 1 million, depending on what I'm able to provide and get investors excited about. So I won't talk about all of these things, but again, here, this really focuses on the team, so the founders, and then where your company is in terms of product. So the more you're able to show that you have a strong founding team or are able to hire amazing talent as co-founders or as early founding employees, and then the more that you have from your product, the more you will likely be able to raise in terms of capital. So again, just as an example, only having an idea on paper, if you are an experienced founder, i.e., I have already raised a venture-backed company, but let's say, it didn't get acquired for $1 billion. The fact that you already have started a startup and have raised venture goes a significant way to telling that investor, okay, this person understands a little bit about what they're signing up for, and thus I am more confident that they will be good stewards of this capital, as opposed to somebody who hasn't raised venture capital before. This is the first time starting a business like this. So again, are there exceptions to this? Certainly. I'm sure people in the room know exceptions to this, but again, I do think it's important to understand where your product is or could be whenever you are fundraising, and then depending on what your team makeup looks like, how that is tied to the amount of capital that you would be able to raise. Any questions on the slide? No? All right, feel free to just come off mute or raise your virtual hand or type it in the chat. So one thing I like to talk about here is, because we're getting pitched dozens of companies all the time, you as a founder should try to put yourself in our shoes. And if you were hearing this pitch for the first time, these are some of the questions that you have in the back of your head that are going, it's not necessarily a checkbox. You're not trying to check the box like yes, 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 no, no, no. But these are some of the questions that you're trying to get signals about and figure out, okay, some of these components of the business are really strong, and thus I am more interested in learning more about this company, learning more about this team, spending more time with them to hopefully actually invest. And there are different ways to signal different components of these. And so you want to present the strongest case possible, but depending on where you are, the folks in the room with your company, you can sort of reverse engineer to say, okay, I'm going to be fundraising in December of this year. And so I know that my weakest area is my team. And so I am going, but I know I have a strong product, people are using it, people are paying for it, but I know that I can go further with a strong team. And so I'm going to focus on hiring world-class talent and getting, while you might not have capital to pay this amazing talent, you can offer advisor. You can get them on as advisors. You can offer equity. You can get them in some sort of contract rate. And again, people whom otherwise, at least on paper, have no business joining this company because of how early and how much risk is involved. The fact that you've been able to enlist them in your company goes a long way. So these are some of the bullets that you want to be mindful of, that investors are thinking about, and you want to convince them that you understand what it takes to hire world-class talent, that you have that you and only you have an understanding of this very unique problem that the vast majority of people don't, and maybe it's actually contrary to think about your point. So investors are looking for very unique ideas. If it's a copycat of something, that's not saying it's going to be an unfundable idea, but venture capitalists are looking for innovation. They're looking for an idea that not necessarily hasn't been tried before, but if you are trying it, convincing them of this is the right team to build it, this is the right time to be building this, and this is the right way to build it, because it's very likely that there's been somebody else who's attempted to build that before. So conveying why you have this very unique perspective, one of the things that we say often is your competitive advantage is your lived experience. And so showing how what you've been doing up until that point is driving that unique insight can go a long way. You also want to convince them that you know how to build a product, ideally in a relatively short amount of time, because undoubtedly you're going to have to pivot the company strategies. Maybe the product that you started off with wasn't the product that customers wanted or that your user wanted. So the fact that you either have worked at a startup before or were at a tech company that built products where you had to act in a more startup environment, like, you want to show that you can do that, because that's what you're going to be doing with the capital that you raise, showing that people want to use and pay for the product. Again, if you are post product and post revenue, you're going to have the data. Ideally, the data is organized depending on how much time you've been in market. You have cohort analyses, but if you don't, then getting creative with, hey, surveys, wait lists, doing things manually that don't scale at first, but you're able to show that there is clear market demand for it. And at the end of the day, that you can run a business. So you are asking people to invest in you a significant amount of capital, and you're going to be good stewards of that capital, and you're going to be you know that you're signing up to run a business. This is not a one person show, and you're going to have to enlist other people. You're going to have to think about motivating, retention, hiring, firing, and that you're ready for that journey. And then lastly, that you're actually excited about working with them being the investors. So if you're talking to somebody, hopefully you've done a little bit of research and you understand how they operate. Maybe you know a company in their portfolio that you've been able to talk to, and you're excited about working with that fund for some unique reason. Again, there are thousands of venture capital firms out there. You thankfully have options of who to pitch and who ultimately you get to put on your cap table as long-term partners. I'll pause here if there's any questions. Alrighty. Well, 3 more slides that I will breeze through. This is just a quick one about the investment vehicle. So in terms of types of capital, you can raise on a SAFE, you can do a priced equity round, or do a convertible note. There's a 4th category of other types of capital, but like pure loans or revenue-based financing, et cetera. I won't touch on those because generally speaking, the most common are SAFEs, priced rounds, and convertible notes. Here, again, there's data from Carta and other publications, depending on the amount that's typically tied to the vehicle. So if you're raising a smaller amount, it's typically easier because it's cheaper and faster to do a SAFE than it is a priced round. A priced round, you see a lot more whenever you're raising $3+ million. Priced round actually means you're exchanging equity. There is a stock price for the stock that you are exchanging to the new investors, and lawyers are involved typically. This is a convertible note, compares SAFEs versus convertible notes. It doesn't talk about the share or the split, but if I had to guess, at least even in our portfolio, 10%, about 10% of the companies raise on a convertible note. And here, just to give you a sense of the industries that those companies are in, you can see that the bottom ones are the ones where convertible notes are the most common. So just something to have in mind for yourselves as you think about amount and also the vehicle. The vehicle is not something that you have to worry too much about, because typically whenever you have, unless you're raising, again, like under $500,000, if you're raising more and you're pitching an investor to lead the round, that investor will likely tell you what they want to invest on, whether that's a SAFE, again, depending on the amount. Investors understand the costs to get these rounds done. So typically, if you have a lead, they're going to tell you in the term sheet, we want this to be a SAFE, we want this to be a priced round, and you can have that conversation at that point. Any questions here? No?
Yes,
Right.
I have a question real quickly.
Yep, please.
My question is, on the convertible notes, how much negotiation is there when you're pre-seed on a convertible note?
Yeah, so pre-seed, well, so to answer your question, most things are negotiable, but I would negotiate that at the appropriate point. So if you're coming into the first conversation and you're saying, hey, before you even pitch the company, I want this terms on my convertible note, and like that's putting the cart before the horse, if that's the right way to say that analogy. But so once an investor has said, hey, I want to invest, here's a term sheet, and let's say your lawyers get involved, maybe you're working with a startup lawyer. I mean, generally speaking, a lot of law firms are willing to work with startups at some sort of slightly reduced price. But if at that point you feel like some terms are not favorable, it should be a conversation. I mean, if you've gotten a fund to the point where they want to invest, generally speaking, they don't give offers out that often, and thus they don't want to lose a deal. So if it is something that you want to bring up, it should be a conversation. Now, they may not agree with your recommendation, and you might still have to go with the terms that they are doing, or you're able to actually have multiple investors that want to invest, and that would be the most ideal scenario from a leverage perspective. If you have 2 investors, and you're saying, hey, look, I want to go with you, this term I'm not comfortable with, can we work on this? I mean, hopefully you're not doing that just for the sake of pitting 2 firms against each other, but you're doing that for the sake of, hey, look, this other firm is offering me this other favorable metric. Can you match it? And if so, I would love to work with you, et cetera. So that is the ideal place to be in, have leverage, because you have multiple people that want to be investors in the company. And maybe you actually add both investors to your cap table, but you want them to be both receiving the same terms. That could be another perspective. But if you don't have another investor and this is the only offer that you have, it should be a conversation. And um, an investor doesn't want to start the relationship on a bad note, so they don't want to start off with animosity or like, hey, you're taking advantage of me, because you shouldn't want to be in that type of relationship. So hopefully they're not putting up very uh, usurious or just terms that are taking advantage of the founder or the company. But most things are negotiable. So I would say have the conversation, but at the appropriate point in time. All right, just two more quick slides. Some tips for optimizing for a successful fundraise. Some of these points I've already touched on, but just to reiterate them. So you will get far stronger results if you actually run a formal process. What I mean by formal process, and again, I think we dropped in our YouTube links to some of the other Slauson Spaces that we've had, but being organized, starting a process as opposed to contacting one investor here, approaching them, trying to get them to invest, and then maybe they pass, so you start off with another one. If you have all of your materials squared away, the business has just had a phenomenal last quarter that really is driving the story of why you're investing right now. You have your prioritized list, and then you're reaching out to folks to get on their calendars a few weeks in advance. Your team knows that you're fundraising. You have the first 2 weeks of July blocked off to fundraise, and then you know that you're going to start off with 50 conversations, first calls, and that's going to whittle down from 50 first calls to 30-second calls to 23 plus calls. And ultimately, what you're looking for is a couple of folks that want to invest. And so you have to plan that in advance. It's not something that you just start. And sometimes you do, but again, that makes you have to scramble more for the right information. And so it just puts you not in the best position. Second is have realistic expectations. Again, you might sometimes we get founders that are saying, "Hey, I want to raise $5 million by the end of this month," and having a timeline is not a negative thing, but if that timeline is unrealistic, and like if we hear that from, and we do sometimes, founders tell us like, "Hey, this is my timeline," we have to then, you're putting us in the react mode of like, well, if I have to make a decision, I can make it, but the reality is a decision isn't made on one conversation or even two, generally speaking, it's made over time. And even better if you've been able to build a relationship outside of just purely pitching them so that the investor can get to know you, follow you, maybe you're adding them to your investor updates, and then over time seeing the pace with which you're moving. Hey, through the emails, this founder, they hired this new person who's doing really well, or they just launched a product. I just downloaded it, I'm using it. I really like what they're building, versus, hey, this is the person that I'm meeting you and I'm asking you to give me $1 million, not give me, but invest $1 million in the company. So we get all flavors of that, but having a realistic timeline will help you set you up for success. Definitely recommend practicing your pitch. Look for other founder friends. If you don't have many founder friends, you have access to at least 5 or 6 here on this chat, so you can ping each other and practice, because you want to make sure that over time, if people have the same question over and over again, there's a reason that they have that question. So you would probably want to incorporate that into your pitch or your pitch deck. And so having people that can give you that frank, honest feedback will help set you up for success. So practice makes progress. And then lastly, again, we've talked about this, but reiterating, if you have your materials squared away, a data room, which we've talked, which again, the Slauson Spaces we've done on just a data room, having those materials set, and maybe you'll still have to edit some of them. For example, an FAQ for some nuanced questions that comes up as you're pitching. But the more you are having things organized, you're able to just quickly share them as you're being able to move from first call to second call to third call. All of these different documents, all of the different data that investors will ask, you've already set up, and it's just a matter of sharing it with them, as opposed to trying to put that together after an investor asks for it for the very first time. That's going to just delay you in getting that information together. It's going to delay that investor being able to review that information and thus make a decision, and thus will prolong your process. So the person that said they wanted to raise $5 million by the end of June is now in August because they've had to do materials from scratch because they didn't have it from the get-go. There's a question on pre-seed documents that we should have in your data room. So there's company data, and then there's there's data based on where your company is, and then there's just legal documents. So at a minimum, you have the legal documents for whenever you actually want to close. If you don't feel comfortable sharing that for any reason, you can just add that to a data room. So these are a little bit more nuances, but for example, sometimes investors make we see investors make like our own Slauson data room, and they're adding things in over time, but they're just copying it over from another master data room that they have. So to answer your question, it's a little bit of a non-answer in the sense of it depends on where the company is. So the more data you have, let's say you're post-product, post-revenue, people are going to want to ask for some of that data. So cohort analyses, but if you don't have that, you want to share as much information that you feel will be relevant in the pitch. So if you're pre-product, pre-launch, however, you've been doing 400 interviews, that can be some of the information that you have included there that validates why there is a need for what you're building. So think about what data you have. You don't have to make up data, but think about what data you have, what data will be relevant, what data will an investor want to see, even if it's not data, like small things, references, if you want to get ahead of that, any market research that you have access to, those, and you can organize the data room and label it accordingly. But you likely have a lot of materials that you may not have realized. And so it's not about bombarding that investor with like 50 folders. But again, putting yourself in an investor's shoe, if this is the first time the company is learning about this industry, you might have to educate them more than you would want to, but that's part of your job because you're trying to convince them that this is a large opportunity or this is a large market. And so, like, for example, a market research report or something will be relevant to have in that data room. Last slide. So things to do and then things to not do. One thing that we caution folks and ask them to be mindful of is things around cap table. So sometimes folks raise, for example, if you raise on a bunch of different valuation caps, safe notes, we're not saying that that's a negative thing per se, but we are trying to make that founder mindful that that will have implications for dilution and or even just keeping things organized. So, you know, if you can only raise on a lot of different valuation caps from small check investors, that's not the end of the world, but you want to be mindful, or maybe you took on some debt, but it was structured really weird and you issued a bunch of warrants. Like if you got really creative, you just want to be mindful, and hopefully you have some good legal counsel that can advise you on what are things to do versus things not to do. So thinking about it from a cap table perspective. The second point, again, I touched on legal team. So there are plenty of law firms that work with startups, again, usually at a subsidized or discounted rate, because they know that whenever you raise a Series B in 5 years, they're going to be able to actually make good money. So at the early stages, they're willing to work with you. And usually, while they might be more expensive than some boutique or individual, it's worth it because they know the standard documents, standard terms, and you want that. You don't want that to hinder you having people that don't work with startups. The third point is around self-pricing. So again, in 2021, because of the environment that we were in, a lot of founders would get on a call to pitches and say, "Hey, I'm raising 5 million at this valuation. Like, are you in or not? Tell me by the end of Friday." And that was a very wild, wild west experience. So self-pricing is they are telling the investor what the terms are, as opposed to a company pitching an investor and ultimately getting a term sheet, which will dictate the terms of the deal. Now, we still see a little bit flavors of self-pricing. We, to our portfolio company founders, don't advise this. Because to your earlier question around what's negotiable, like what you're trying to find whenever you're pitching an investor is, do they understand what this is? Are they interested? Are they willing to come on this journey with me? And if you are able to get to an offer, at that point you can have a conversation about valuation or a board role, etc. But if you're from the very first conversation telling people what you're expecting the price should be, not the worst thing, but you are then saying, I know where the market is, and I know that my company is worth this much. Whereas you only have one, maybe 2 or 3 data points because you have founder friends. We have dozens and hundreds of data points. Like if you're saying, hey, I'm raising, I don't know, 2 million at a $20 million valuation, and you have like 10K in MRR, and the next founder that pitches us has raised less money, has higher revenue, is operating in a bigger market, and let's say they're not self-pricing, but from the amount that they've raised and taking into account dilution, that deal is likely more at like a 13 or a $15 million valuation. That the person who said that they want to raise it at 20 is now shooting themselves in the foot a little bit because they don't understand where the market is. Now you can signal, hey, I'm looking for 10 to 15% dilution. And you can back into what an investor might invest at by asking them questions. Hey, what are your average check sizes? How much ownership do you typically seek? And you can back into what the valuation ranges would be. But again, we don't advise self-pricing because investors going to have more data than you do. Balancing real versus false urgency. So some very good founders have a very thoughtful way to approach how to talk about the round. Again, if you are running a process, some small signals of like, hey, where are you with the round? We would ask, where are you with the round? Say, you can say like, hey, we don't have a lead, but we are in third conversations with 3 different funds. We're expecting a term sheet next week. Now, if that is completely untrue and false, I don't want you to lie, but think about how to run a structured process because you have all of your materials in place, you've been practicing, and then it's the process of going from first conversation to multiple conversations to hopefully offer. And in that process, you're moving people along, you're keeping them excited, you're sharing, you're answering their questions, you're introducing them to customers, et cetera, et cetera. And that should lead to an offer, as opposed to just making things up, which are not true, but you think will help create FOMO. Be mindful of that. Having your materials ready to go. And then lastly, not understanding your numbers. So hopefully no one here, I'm sure no one here does it, but oftentimes we ask very basic questions. What was your revenue last month? Like, how many users do you have last month, et cetera. And sometimes people say, oh, well, I have to check, or they answer the question but don't give you a straightforward answer. That's like, well, we generate this, but our take rate is this, but we had some discounts. Like, you should know your numbers. No one else should know your numbers better than you. And if you answer questions and leave an investor uncertain about what the answer was, that's not a positive signal. So this was supposed to be a lot shorter of a presentation, but hopefully it was relevant to folks. I think there's maybe 1 or 2 questions in the chat. One question about articulating opportunity for an exit to friends and family members who are in VCs. I mean, this really will come down to that individual's financial acumen. I guess if I was you, I would have market comparables. So I would help them, I would show them data around similar companies in similar spaces that have been acquired or gone public recently, let's say in the last 5 years, to show people, hey, look, if all goes well, these are examples of what success could look like for us if this company, if you invest, and this is how much return could be generated. So the more that, even with investors, especially if it's a new industry that the investor is not super familiar with, if you have the data to say, hey, we're building some sort of brand, consumer packaged good brand. Companies in our space are being acquired for 5 times revenue multiple. We think we can get to $50 million, and thus we think we can be acquired for $250 million. These other 3 companies were acquired for even higher than that over the past 5 years, etc. So from an angel perspective, again, it depends on the level of financial acumen. But if you have the data to show them the opportunity, because it's been done in the past, that's one way you could start. Hopefully that answers your question. Seeing if there are other questions.
Yeah, can I just ask?
Yeah, please.
Cool. Thanks. I had a question on the building relationships with VCs. So VCs always mention that, but I find when you're actually building your company, you don't really, in your day-to-day, you're not going to meet VCs. And so, when you run a structured process, you reach out to people. And in my last company, most of the people who ended up investing were people I didn't know when I started it. But then VCs always say, oh, we'd like to get to know you beforehand, see some progress over a few months or whatever. So how do you build relationships with people while you're building your business? And I'm just interested in that, and in the how do you what's your strategies or thoughts on how to do that?
Sure. So the short answer is great founders are very innovative when it comes to most things. By most things is if somebody wants an introduction to somebody, they will figure out or they will attend events, or they will get introduced to an investor through portfolio company founders. Now, this isn't super scalable, so you can't do this for dozens and dozens of funds. But if you have this prioritized list of investors and there are 3 to 5 that would be amazing partners for you, even before you start the company, in as much as you already have the idea and you know that you will be building it at some point in the future, starting to have those conversations with them, getting introduced to other investors, even if they might not know them, but investors know investors, and there's no straight path, unfortunately. But we see a lot of founders I'm not joking when sometimes 4 different people tell us about this one company. And maybe we're not that interested after seeing the initial materials, but because so many people, we're so human in the sense of we're susceptible to people's social pressure of hey, this founder is amazing, or hey, this idea is amazing. So the more that you can crowd an investor with information that's favorable and ultimately get an introduction, and you can start that conversation off with saying, hey, I'm not fundraising, but I know that you specialize in marketplaces, or you specialize in health tech companies. I'm building something here, or I plan to build something here. I'd love to ask you a question about X, Y, or Z. Or attend events. You unfortunately have to get creative, and good investors will be creative because they have to be in order to build a successful company. So the short answer is the earlier the better, but you have to be strategic with where you're doing that, because it's not super scalable to do that for a lot of funds. Yeah, I know we're over time. And then Justin, you had a question about retail consumer brands. So my short answer to your question is you really want to find investors that understand D2C and or CPG. And you can do that by looking at their portfolio. So the more an investor understands that space in that world, the easier it'll be for that founder to educate them or to describe the opportunity, as opposed to trying to convince somebody who just does B2B software sales to invest in the CPG D2C company. The education bar is going to be a lot higher. So going to that prioritized list finding the folks that this will resonate with, it would be in your best, it would behoove you to do that, as opposed to trying to convince somebody who is less convincible. But happy to answer your question. Thanks for joining us, especially those that joined for the whole hour. This will be on YouTube, so if you can reference it or share with others. And yeah, pleasure to be with you all this morning. Have a great week.